All right, quick legal disclaimer before we dive in. This is for educational purposes only. It is not financial advice. As you know, investing always involves the risk of loss. Okay, let's get right to it. Hit the like button, subscribe to the channel, and comment your top ticker right now. Retail is looking at standard charts, but the options tape is leaking the real institutional playbook. Wall Street just bought 5 times as many puts as calls on corporate debt. Today, we expose the hidden crash bets in the options market and how to front-run the rotation. So if you just look at the surface, yeah, the equity story looks pretty good, right? The S&P 500 is flirting with all-time highs, and our own positioning models over at 42 Macro, they confirm it. Retail traders are way, way overweight stocks. But here's the thing. That's the consensus view. And you and I both know consensus doesn't generate alpha. The real story, the one that always comes before those huge market shifts, well, that's being written in the debt markets. And let me tell you, what that market is screaming right now is that the foundation, it's starting to crack. All right, so let's dig in. Let's go uncover that signal. What we're after here is the hard quantitative data, the stuff that flies right in the face of the mainstream story. This isn't about my opinion. It's not about some wild forecast. It's about one thing and one thing only: following the money. And this isn't some theoretical problem, some what-if scenario. No way. Just look at this chart of U.S. corporate defaults. Both the number of defaults and the total dollar amount are in a very clear uptrend. This is the first layer of the onion we're peeling back here. This is real, tangible stress on corporate balance sheets. We're seeing it hit high-yield borrowers and those lower-rated issuers who are staring down a massive refinancing cliff. You know, this real-world stress is exactly what our quantitative models are built to sniff out long before it ever hits the headlines. This table right here, it's pulled directly from the 42 Macro Discretionary Risk Management Overlay. Their model, the Volatility Adjusted Momentum Signal, we call it VAMS, is screaming short. I mean, it's explicitly flagging short trades on both high yield, that's HYG, and investment grade credit, LQD. Listen, when disciplined quant models flash unambiguous short signals across the entire corporate credit spectrum, you don't ask questions, you just pay attention. So the big question is, how are the institutions actually playing this? What are they doing with this data? Well, I'll tell you what they're not doing. They're not just selling bonds, no. They're making leveraged asymmetric bets in the one place retail never seems to look, the options market. So let's break down their playbook, step by step. Okay, look at your screen right now. This is it. This is the core anomaly. The put-to-call ratio for the investment-grade corporate bond ETF, LQD, just printed a mind-blowing 5.03. Let that sink in. For every one call option bought, 5 put options were bought. That is a massive directional bet on a credit breakdown. And it's not just there. We're seeing a similar story, maybe a little less extreme, over in the Semiconductor ETF SMH with a 4.41 ratio. Now here's the kicker. Contrast that with Microsoft, MSFT. Its ratio, just 0.33, that's a ton of call buying. Folks, this is not random noise. This is a highly targeted capital rotation. So what does all this technical jargon actually mean? Let's translate it. In plain English, this means Wall Street algorithms are front-running a corporate credit freeze. They are paying massive premiums to short corporate bonds and broad semiconductor indices, while hoarding cash-rich monopolies like Microsoft that don't rely on cheap debt. It's a classic K-shaped recovery play. They're dumping assets that get crushed in this kind of environment and piling into the ones that thrive. At its core, they are betting on a massive divergence in the market. So the strategy behind this whole institutional rotation, it's a pretty sophisticated play called capital structure arbitrage. And here's how it works, simply put. Institutions are looking at the cost of insuring against default, through things like credit default swaps or CDS. And right now, they're looking at that price and saying, that's wrong. That risk is totally mispriced. They see that buying put options on these debt ETFs is a much cheaper, much more liquid way to make the same bet on that default risk. So when they see the puts are undervalued compared to the actual credit risk, bingo, that's an arbitrage opportunity. And they are loading up the truck, expecting the options market to violently catch up to reality. And this is where it gets scary. This is the systemic risk. We're not just talking about a few companies going under. The real danger here is contagion. And don't take my word for it. This quote is from a DTCC filing, the clearinghouse at the dead center of our entire financial system. They are explicitly warning that a credit event can trigger runs, which would force institutional lenders to just dump assets to raise cash, creating, in their own words, fire sale conditions. And that right there, that's the trigger. That's the mechanism for a massive liquidity drain that spills over from the credit market and crashes right into the equity market. Before we map out the bear and black swan scenarios for this trade, hit subscribe so you don't miss our weekly dark pool audits. Okay, now that we understand the threat, let's really map out the 3 most likely ways this whole thing could play out. All right, let's walk through these. Scenario 1 is the bull case. We're calling it the decoupling. This is where that rotation we just talked about just keeps going. Capital runs screaming from debt-heavy companies and piles into the fortress balance sheets like Microsoft, squeezing them higher while the rest of the market just bleeds out. Okay, scenario 2, the bear case, the crack. Honestly, this is what the institutions are betting on. The corporate debt wall finally breaks, LQD just plummets, and all those puts go deep in the money. Their execution triggers that exact liquidity drain the DTCC warned us about. And then there's the black swan. This is a sovereign debt downgrade. This is the absolute nightmare scenario. The entire bond market freezes solid overnight, collateral chains just snap, and we get a systemic cross-asset fire sale. So given these potential outcomes, risk management isn't just important, it's everything. You have to shift your mindset right now from profit generation to one of absolute capital preservation. And that means you need a strict, rules-based framework, no exceptions. And let me be perfectly clear, these rules are non-negotiable. First, every single trade must have OT brackets. That means one triggers the other. Your profit target and your stop loss get entered the second you enter the trade. Second, your stops are not just some random number you pull out of the air. We use a 2.5 times average true range trailing stop protocol. This adapts your risk to whatever the current market volatility is. And third, this is an absolute rule. You do not buy any leveraged asset that is trading below its 200-day moving average, period. It's a simple, systematic way to keep you from trying to catch a falling knife. Discipline here isn't a suggestion, it's mandatory. So let's just be crystal clear about what we've looked at today. This isn't a forecast. This is not my opinion. The options tape is a factual ledger. It's a record of where real institutions are committing billions of dollars in leveraged capital. And right now, that ledger is showing a massive, coordinated bet against the very stability of corporate America's balance sheet. Look, the signals for the next major market move, they're never on the front page of the news. They're always buried deep in the data. The information is out there. The only question is, are you looking in the right place? If you want to trade with a quantitative edge, hit the like button, subscribe to the channel, and drop a comment below with your specific thoughts on the options flow and the tickers mentioned LQD, SMH, MSFT.